Hello, and you're welcome to this special edition of Global Business Insights, where we look at the decision just made by the U.S. Federal Open Market Committee, that's the Federal Reserve Rates Committee, to cut rates for the first time in 4 years. Today, the focus is on the US FOMC meeting just concluded, and where a decision to cut rates by a bold 50 basis points for the first time since the COVID-19 pandemic was made, in a move seen as driven by the need to stimulate the economy. The Dow surged over 100 points as the decision was announced. Indices turned positive as many had priced in a 25 basis points cut, though the odds of 50 had of late increased. But first, some of the other headlines. An EU court has ruled in favor of Google's appeal to overturn a nearly $1.7 billion antitrust fine over its online advertising practices. Meta Platforms also won the dismissal of a lawsuit claiming it defrauded shareholders by concealing how changes to Apple's privacy settings make Facebook and Instagram less desirable for advertisers. The International Association of Machinists and Aerospace Workers said Boeing and its largest union are continuing contract talks in the presence of federal mediators after failing to agree on key issues such as wages and pensions. Boeing Chief Executive Officer Kelly Ortberg also said that it will temporarily follow numerous U.S. executives and other employees after about 30,000 machinists went on strike last Friday, halting production of its 737 MAX and other airplanes. U.S. single-family home building rebounded sharply in August as housing starts jumped 15.8% in August. Permits for future single-family buildings also rose 2.8%. And now to our main story. It was indeed an aggressive start of the easing cycle as the Federal Reserve enacted its first interest rate cut since the early days of the COVID pandemic, slicing half a percentage point off benchmark rates to 4.75 to 5%. This was to avert a slowdown in the labor market. The last time the FOMC cut by half a point was in 2008 during the global financial crisis. This is as personal consumption expenditure index for July at 2.5% is slowly trending towards the 2% target. August unemployment at 4.2% seems to be inching up, and the gross domestic product, an indicator of the overall health of the economy, grew 3.0% in Q2, up from 1.4% growth in Q1. The US economy looks resilient enough despite many other predictive macroeconomic indicators suggesting a recession can still not be ruled out. Ahead of the meeting, the CME FedWatch tool showed markets rather optimistic, currently pricing in a nearly 60% probability of a 50 basis points interest rate cut against a nearly 40% chance of a 25 basis points reduction. Only one member, Governor Bowman, voted for a 25 basis point cut. Also, the press statements has some new emphasis on slowdown in job gains while noting inflation remains elevated and adding a strong commitment to supporting maximum employment. It appears the emphasis reading the statement has shifted towards employment, not just price stability. Here is a clip from the press conference today after the decision was announced.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up but remained low at 4.2%. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished, and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a 0.5 percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
The summary of economic projections released today also revealed that the 2024 and 2025 median projections for GDP was moved from 2.1% and 2% respectively in June to 2% and 2%, slightly lower in 2024, in the latest September projections. 2024 and 2025 median projections for unemployment rate also been raised significantly from 4% and 4.2% respectively in June to 4.4% and 4.4% in the latest projections. For core personal consumption expenditure, that's the inflation index, the 2024 and 2025 median projections were revised downwards from 2.8 and 2.3% respectively in June to 2.6% and 2.2% in the latest summary of economic projections. In short, we have slight GDP change, unemployment seen as going much higher, and inflation seen as coming down more than previously forecasted. The dot plot showed that most members still see another 50 basis points cut by year end, taking the rate down to 4.25%. It was a very volatile day for markets. Despite getting the 50 basis points cut that traders wanted, the market still could not sustain a rally. Indeed, there was an initial positive movement, followed by giving up of all gains, leaving indexes mostly in the red. Even as some read the 50 basis points move as a sign of panic in view of an economy looking much weaker than expected. Well, that's it from me on Global Business Insights. This is Bodio Shosami. Thanks for sharing and following or subscribing on Facebook, LinkedIn, or YouTube and X. Thanks for watching. Bye-bye.